This is BioRect, a strategy I put $50 into a year ago and is now up over 174%, and that is with real money, not paper trading. In the last episode, I explained to you how algorithmic investing works, and I showed you my portfolio of machines that I've been running. So if you haven't seen that video, go watch it first so you can get an idea of what I'm talking about in case you have no clue what you're watching right now. In this episode, though, we're going to dive deeper into winning strategies, specifically mean reversion strategies. I'm going to show you my second portfolio, which is actively managed, as well as we're going to talk more about staying away from dangerous investment strategies, and if I have time, I'm actually going to build a strategy with you, which I'll give to you for free. So in the last episode, we dove into a few different strategies. I'm going to hop into BioRect here, and I want to show you something on mean reversions. So again, if you haven't seen the last episode, go watch it so you understand what a mean reversion is. I'm going to take this strategy here, Better by the Dip NASDAQ by Garen Phillips, and I'm going to show you how to isolate strategies and check mean reversions. We're going to open up a new block here, and we're just going to paste in Better by the Dip NASDAQ. What I'm going to do is go over to the Discover page, and I'm going to show you the strategy that this was actually evolved from, which is on the home page of Composer. If we go to Technology Focus, you can see By the Dip NASDAQ right here, and if we edit this, we can go into the logic, and you can see that this is basically the strategy. QQQ -5, 1 day greater than 5. And if we go back to Better by the Dip, you can see it's basically the same logic, just a little bit tweaked, and then we've added a few more pieces here. But most of all of these are just mean reversions. Whenever you see a strategy that is stair-stepping like this, that's telling you that it's a mean reversion. And like I said in the last episode, mean reversions are one of the best ways to beat or outperform the S&P 500. So if we run this back to 2017, you can see that it doesn't always work perfectly. There are times when it goes down. And you want to keep that in mind with mean reversions, because there are times when it might snap back or just not perform correctly, but over a long time frame, it will. So that's the importance of looking at backtest as well as looking at the out of sample performance. And I think if we go to the actual performance here, the strategy was started February 14th of 2022. And when you open this up, the backtest should go back to that point. And you can see that this is out of sample performance for this strategy, and it's been performing really well. It hasn't triggered much over the past couple of months, but that's because the market's been on a downturn. But even though this strategy's basically been flat for the entire time, you can see that it still has an annualized return of 26% and a 15% drawdown, which is half of what the S&P 500 was through this period. And when you go in and edit it, you can actually get even better performance just by switching out the bottom strategy here, and we'll just invest in the S&P 500. And when we run this back, now you can see you still get the mean reversions and you get the outperformance or the regular performance of the S&P 500. And if you haven't seen my guide on everything you need to know about building algos, there'll be a link below. But in this guide, if you go under building algos, there's a link here, common mean reversion strategies, where I have a video that walks you through all of the most common mean reversions that you'll see in algorithmic investing. And you'll get access to all of these algos by clicking on the link here to take you to the welcome package. So that's mean reversions. Now let me hop over to my actively managed portfolio, which I haven't shown you yet, but what we've been looking at for the past 2 episodes was my Darwin portfolio, which is basically just a test bed for me. Now I want to show you the actively managed portfolio and the differences between that one and the Darwin portfolio. This is my actively managed portfolio, and I'm just going to turn on the top strategies here to show you the performance of this portfolio. Now, the ideas behind this portfolio was I basically wanted to actively tweak and manage and change these strategies as I learn more as time goes on. And the way that this portfolio was built was I actually took the best strategies from the Darwin portfolio and basically built my own custom algos using those branches of logic. So let's hop into one and I'll show you. And you can see these are the performances of the strategies that I've been running, I believe since March, basically April 1st, March of this year. They hit a top end, some of them hitting 50% or more returns through this period, but they actually had a downturn through this current market cycle. And what I'm doing is actually trying to improve these strategies. So I can drop a line here on when these strategies were basically launched, right about here, and they started to have issues in performance here because most of them were built off of the 200-day moving average. So some of the logic just was a little wonky here. So what I've been doing is basically improving and trying to work and design more strategies to blend and smooth out the equity curve of this portfolio. And in fact, if you want access to all of these algos from both my Darwin portfolio and my actively managed portfolio, just check out our website, and on the top right there's our portfolios. You can click on that that and learn more about getting access to all of these algos that I've been building and putting together for over the past year or so. So what we're going to do is jump into one of the strategies that I've built that I really like, which is called lightning leverage. And to show you that strategy, this is the live performance. It hit a top end of 37%. Currently it's up 16% or so. And when we do a back test simulated over like I think we can go back quite a long ways. We can run the back test to 2017. Unfortunately, the out of sample line changed because I actually just edited this logic. But you can see this is the back test over a certain period. I can go over to the hedge night, which is very similar, and I can show you the back test to that period because I have not modified this logic yet. But you can see the out of sample performance. This is what it's done. And if we do a 3-year back test, it's still pretty consistent to its back test. But let's hop over to lightning leverage. And I'm going to show you a style of strategy design that's called Switchboard Algos. This is actually a fairly unique style of algorithmic design. I actually was just able to create these maybe 2 or 3 weeks ago because the functionality for Composer was not available yet. Essentially, the way a switchboard works, if you have not gone through my guide, definitely go through it because we go through all of the different types of algos, and switchboard algos is what we're going to be looking at today. So a switchboard algo can be identified by basically seeing all of these sort functions. So we have a sort function here, another sort function, another sort function, and another sort function. And if I open these up, you've got a bunch of individual strategies. So these are the individual strategies. These are the best ones from my old portfolio. And you can see that this sort function will select the bottom 2 standard deviation of 20 days. And this one will take the top 2 standard deviation, and then top 2 moving average, and top 2 RSI. So what we're doing here, standard deviation, again, if you remember from the last episode, is basically throttle. So high standard deviation selects the most aggressive strategies. Low standard deviation selects the least aggressive or least volatile strategies. Lowest standard deviation is great for getting a very smooth, stable equity curve because you're basically buying the most stable algo or asset that you can buy out of that basket. High standard deviation, though, is like the most aggressive, full throttle strategies.
You guys silly? I'm still gonna send it. Well, that hurt.
Which, again, standard deviation can be dangerous to select for high standard deviation because it's indiscriminate of whether that asset is going up or down. If a strategy is crashing and burning and you select high standard deviation, you can be selecting the most aggressive crashing strategy, which is super dangerous. So the way to combat that or protect your portfolio is with a switchboard algo, which is the second level or the second layer of sorting here, which is the 7-day max drawdown bottom 2. What this switchboard is doing, you can imagine a switchboard of LEDs and algos turning off and on. A switchboard is designed to select the best ones that are performing based on your criteria. And I don't know if this is actually something of a design that someone else has already created. I just call them switchboards. I created them couple weeks ago when I started to tinker with these different sort functions. But what we're doing here, the 7-day max drawdown is essentially saying we're taking the 4 sort functions and we are only wanting to select the 2 that are the smallest drawdown. So we want to select whatever is the least amount of drawdown over a 7-day period. And theoretically, as time goes on, we will prove whether this works or not. Theoretically, though, we're going to be rotating between the higher standard deviation, the lowest standard deviation, depending on whichever one has the smallest drawdown. So that way we can hopefully maintain a stable equity curve as time goes on. And we're going to capture the aggressive strategies when they're moving up and they have the smallest max drawdown. And if they start to tank, then hopefully they get turned off and we switch to the lowest standard deviation strategies. So we're basically just rotating or switchboarding back and forth depending on what's happening. Now, the last 2 is the moving average returns and the RSI. This is pretty simple. We're just selecting the strategies that have the periods going up. Now, I will say that I have noticed a correlation to the number of days that you're looking back. I know for a fact a lot of these strategies that were built here, QLED for the long term, Biorect, bots, if we open these up, a lot of the logic here was built off of the 200-day moving average as well as the 20-day moving average of QQQ. Now, if you notice, some of these logics are 20 days, 25 days, 20 days, and 7 days. You typically want to kind of stagger the days that you're going. And I've actually experimented with 30-day and 35-day RSI and stuff like that. And I found that those actually work pretty well for the sorting functions. Long story short, when you are building individual algo branches, if you're using a 20-day, you probably want to sort with a 35-day or a 40-day or a shorter time frame like a 10-day or a 15-day. You don't want to be overlapping right on top of each other from the actual algo logic and the sorting function, and especially with the switchboard, the master sort function, which is the 7-day drawdown. You want to have kind of a stair-stepping effect, and the idea with that is as the strategies are performing and going up, if the switch hits and goes down and your sort function is also the same, you can get a lot of weird volatility and randomness and noise. I can't show that to you, but through doing a lot of backtesting and a lot of experimentation, that's kind of what I saw. This strategy actually isn't completely built. So what I'm going to do is I've got this other section here called a rebalancer. And this is actually just standard portfolio design. If you come from traditional portfolio management, you typically have stocks and bonds, or you have a high volatility, high alpha investments, and then you have like your stable bonds or your stable assets that kind of smooth your equity curve so you don't have a lot of volatility. Well, that exact same portfolio management process is used in this strategy. I've got 85% of the strategy in aggressive algos, which I just showed you. This is typical 85-15 algo strategies. Then we've got a 12% rebalancer, which these strategies are basically very low volatility, very low beta strategies that are designed to rebalance the strategy overall. This design I've actually proven and tested almost a year ago inside the Discord community, which if you haven't joined, you should definitely join. We ran some experiments throughout the entire community, basically trying to design algos that weren't super profitable, but they were basically zero correlation to the S&P 500. They're called zero beta or zero correlation strategies. Their only purpose is to basically be a flat equity curve that just goes straight up, and it doesn't care what the S&P 500 is doing. We built those, and then we actually put them inside of our aggressive strategies like you see here as a rebalancer. We would just put like maybe 5, 10, 15, 20% of the overall strategy in that like zero beta correlated algo, and we found that it drastically reduced the volatility and the drawdown of the overall strategy, but actually didn't impact the overall performance of the algo too much. So overall, it increased the Calmer ratio, which is basically a ratio of drawdown and returns. And in fact, let me show that to you real quick just so you can see. So what I'm going to do is we're just going to take one of the strategies. We'll take QLED for the long term. This is one of the simplest strategies. We're going to create it. We're going to paste it here, and then we're going to run a strategy here, and our returns are 24% drawdown and a 50% annualized return. What I'm going to do is actually switch this to a specific weighting, and we're going to do just the standard 85 here, and then we'll set the remaining weight to here. And what we'll do is we'll just copy our rebalancers here, paste them. Now, when we run it back, we're going to lose a little bit of return. Actually, we can only run this back to September of 2019. So let's correct that first. Let's do September of 19. So now let's take a look here. We've got 16% drawdown and a 67% annualized return, but this is from this current backtest. So let me delete this and assign remainder, and then we run it back. So we've got an 18% drawdown and a 71% annualized. Now, what I want you to look at is the Calmer ratio. So the Calmer ratio is showing the relationship between returns and drawdown. A higher Calmer is better because you're basically getting more returns for less volatility. So we've got a 3.76 Calmer, but when I add the rebalancers back in, the Calmer is 4.1. So we've increased the Calmer by reducing the drawdown. We got a little less annualized return, but overall, this is theoretically a better strategy because we've got less volatility in it. The equity curve is smoother. Now, we can also tweak this and increase it to 20% and drop this to 80%. Run it back, and now we've got it didn't change the Calmer much there. But what I'm going to do now is I'm going to take these are black Swan catchers. And you can see that this only has a 3% allocation here, and I'll explain to you why that is in a second. And if you don't know what a black swan catcher is, these are strategies specifically designed to only turn on during market crashes like the COVID crash, housing market crash, the dot-com bubble. These strategies are specifically designed to basically hedge and protect your algo or portfolio on a severe random freak event called a black swan. Now, these strategies, I need to tell you, are theoretical because we only have 2 data points of black swan events in the past 20 years. They are basically experimental, and you should not rely on them as historical proven strategies. Basically, you're just kind of trusting the person that built them. I've built a lot of them. I only use black swans that I have gone through and I've actually looked at the logic and I understand what they're doing, because if you put a black swan into your strategies that you don't understand, it can be super dangerous, because there's only been 2 points in the history of the past 20 years where they have actually turned on. So keep that in mind when you're using a black swan catcher. And for that reason, that is why the algos are only set to 3% of the overall rebalancer of this algo here. Let's assign the remainder, and then we're going to run this back, and you'll see a pretty good performance. So we actually increased the calmer just by a little bit, 4.18%, max drawdown is 15%, and annualized return is 62%. So this actually improved the strategies just a little bit, and what it probably did was it improved during the COVID crash right here. And if you want to see how these black swan catchers work, we can isolate them by just opening up a new tab real quick, and I'll show you how these strategies perform. We're gonna paste them in, run the back test, and you can see that they basically only turn on during this period. They kind of have performed a little bit here and there, but they're specifically designed to turn on during market crashes. Let's talk about the 3%. When it comes to using a black swan catcher in your portfolios or inside of an individual algo like this, I like to keep it between 1 to 3%. You could do 4%, but the theory here is if we go to the back test, this one returned a 207% return, which means that 3% would have turned into roughly 6 or 7%, depending on rebalancing, and basically hedged your portfolio or your individual algo by 6 or 7%. Because they're designed as insurance and you're investing in bonds, this flat line here is essentially bonds. You're also getting a reduction in volatility throughout the normal market conditions by 2 to 3%. So you can look at these black swans as essentially holding bonds 1 to 3, 4% through normal market conditions, but they're designed to turn on and protect and hedge and offset your losses when market crashes occur. So that's at least the theory and design. Again, they are theoretical, experimental. Be very careful with how you use them. You probably don't want to have 20 or 30% of your portfolio or algos in them, because in the event that they don't work when a black swan happens, you're only losing 3%. But if you have 20% of your portfolio or allocations in them and they don't work, you're losing a lot of money. So they can be very advantageous, but also very dangerous. Use them essentially as insurance and be careful with them. And again, if you have not seen the guide, definitely go check out the guide, because I walk you through black swan catchers and exactly how they work and how to use volatility strategies. And I show you how some of these are built. All right, so now that that's ran through, let's turn this rebalancer into a switchboard. So what I'm going to do is drop a filter here, and we're just going to copy all of these over. And now we're going to do a sort function, and let's just do standard deviation returns. We're going to do 25 days, just to offset a little bit. And we're going to select the bottom 2. So we're only rotating between 3 here. And let's run the back test, see what it does. So 19% drawdown, calmer 6.1, 130% annualized, doing pretty well. So now I'm going to copy this. I'm going to make another sort function, and then I'm going to paste this sort function inside there. We're going to get rid of that one. And you got to be careful when you do these. It's kind of weird. You don't actually paste in this one, you paste here. And now we're selecting all of the sort functions. So what we're going to do here is we're going to switch this to top standard deviation. So now this is selecting the most aggressive of the two. Then we're going to do a max drawdown of, let's start at 5 days, choose bottom 1. Now I have to be careful that I don't make this logic too long, or else I can't save it. It looks like we can still save it, so I got to be careful that I don't make this too complicated. We run it back. Calmer is increased a little bit. Drawdown, did it increase or did it decrease? I think it increased. Max drawdown 21%. It actually increased the drawdown a little bit. So we'll do a 3-day max drawdown. 20%, that's better. Annualized 6.45 calmer. We're gonna paste one more in here, and we'll do relative strength index 35-day top 2, and we'll switch this to get a bit more diversity. We'll do bottom 2, run it back. 21%, not bad. I'm gonna try something real quick. I'm gonna save this, and I'm actually gonna throw the aggressive, I'm gonna put a switch here, actually. Let's do a 3-level switchboard. I don't know if this is going to work. I've never done this before, but I'm just going to see what's going to happen. We're actually going to rotate between the aggressive and the defensive rebalancer. We're going to add the 70%, and let's start with max drawdown, and we'll just do a 3-day. Bottom one, we're just rotating between two things. I have no idea what this is going to do. It might be terrible, might be great. Doesn't look like it's that great. Do relative strength index, start at a 15-day, 36% drawdown. Yeah, it's not very good. Let's just go back to our traditional portfolio design, because I know that one works and I trust it. And that's actually a good point here. Some strategies might look great on a back test, but what's most important is that you trust them and that you can sleep sound at night. In fact, the reason that I quit manual trading and investing to switch to algorithmic investing wasn't necessarily for the performances, even though they have performed really well. It's just so that I can sleep well at night, so that I don't have to manage my portfolios and manage my stuff, to reduce my emotional stress and the emotional tax that comes from managing portfolios. Because I know how all of my algos work and how all of the strategies are designed, I can sleep well at night. If somebody calls me up and says, "Oh my God, Garen, the market's crashing and what are you doing?" I'm chilling, because I know what my strategies are designed to do. So that's the best thing about what we're doing here. Let's go back to rebalancer. I'm going to copy one more because it looks like we're not at the cap of the size of the strategies. Let's save this, make sure it works. Okay, relative strength index. Let's do moving average returns. We'll do a 25-day, top two, run it back, 6.7. Okay, we're not getting much performance difference. Let's try 7-day drawdown. Might be a little bit too tight with a 3-day. 6.4, 21%. Okay, I'm going to add a strategy in here. I'm going to copy this because I know this is a very low beta. These two strategies right here are very low beta. And in fact, I might be able to actually delete those from the aggressive, add them into here. Because the gold, the Hello Algo World and the Cash USD, these strategies are more like a rebalancer rather than an aggressive strategy. We'll try that out real quick. First, I want to see what they do in the rebalancer. Okay, they didn't change too much with the annualized, but let's now take them out of, we're going to make the aggressive strategies more aggressive. So now we're just rotating between the individual. Okay, so let's see what this does now. Yeah, nope, actually drastically underperformed. Okay. All right. Well, this video is getting pretty long, so I'm going to wrap this up. In the next episode, we will take a deeper dive into building out these algos. And if you want this specific algo, actually go follow me on Instagram. Just leave a comment and a like and shoot me a DM, and I will send you this algo for free so you can get this one. This is actually one of the strategies I've built the most and worked on the most over the past year. And right now, I'm actually trying to hit 1,000 subscribers on this YouTube channel. So if you have not yet, please subscribe because it helps me grow this channel and grow what we're doing here. And I will see you in the next video.